afternoon. Good afternoon, everyone, and welcome to our webinar on transfer pricing developments in Rwanda, which is always a hot topic around the continent. Our webinar will be presented in the form of a panel discussion, but please feel free to post any questions that you may have as we go along on the Q&A section, and we'll address that at the end of the discussion. We're very privileged to have with us on the panel today some representatives of the Rwanda Revenue Authorities, and I'm pleased to introduce you to Innocent and Vincent, both members of the International Tax Department at the RRA, and Judy, who is a consultant to the RRA and also an expert in international tax and transfer pricing. Then we also have Jens, my colleague, that's international and tax and transfer pricing expert based in Cape Town, South Africa at ENS, and Didone, who is a partner at the ENS office in Kigali, specializing in tax. Welcome, ladies and gentlemen, and we look forward to our discussion. So if we can kick off maybe with a general discussion on the main developments in the transfer pricing area around the world. Jens, if I can maybe ask you to start off with just an overview of what you've seen happening in the global situation at this point. Thank you.
Thanks, Celia. I think if one looks at the latest transfer pricing development in the last few years, one needs to look at three main sources. There's the OECD, there's the UN, and there's ATAF. Especially when one looks at development that are relevant for the African continent. So if we start with the OECD, I think it's important to understand that the OECD guidelines have effectively been revamped completely since 2015, and that was as a result of the project on base erosion and profit shifting. So if one would try to summarize the BEPS actions resulting from the project in one sentence, that sentence would be, aligning transfer pricing outcomes with the value creation process. And one must remember also in that context that the focus of that BEPS project was on what the OECD calls low functioning capital-rich entities in low tax jurisdictions, which are perceived to get an excessive share of intergroup profits. So one needs to keep that in mind because that drove a lot of the developments in updating the OECD guidelines. And one also has to keep in mind that that should be read together with the introduction of the multilateral instrument. So to ensure that those low functioning capital-rich entities do not get an excessive share of the intergroup profits, certain focus areas were introduced. And that is kind of in majority three areas. There is the focus on economic substance and what the OECD calls the accurate delineation of the actual transaction. And that means basically that the agreements and the legal reality is only the starting point of an analysis. And ultimately one has to look at the commercial reality of the actual conduct of the parties. So functions, assets, and risk, what we would typically call the function analysis in our old terminology. As well, then obviously also double check whether that comes through all the way in the kind of financial reality, which is then the financial statements. And then also what is important in that context is that in the importance of risk and the importance of intangibles were also re-emphasized in the updated guidance by the OECD. And then all of those focus areas have to be seen again and considered together with the introduction of the three-tier transfer pricing documentation rules. So the introduction of the concept of a CBC report, a master file, and a local file. On top of that very specific focus, there was also a number of practical guidances which were issued. So for example, we had the guidance on intergroup services, which was updated. And there was a specific focus on the introduction of the treatment of low value added services, which effectively introduced a cost plus safe harbor. But in that context, it's also important to keep in mind that that guidance is an elective part. So that chapter of the OECD guidelines is effectively an elective part, and tax authorities do not have to follow that. And in fact, a lot of African tax authorities do not necessarily follow that guidance. It would be interesting at the later stage to hear the RRA's view on that as well. There was also an updated guidance on cost contribution arrangements, although I think that's not that relevant here in our context because that is very complicated to implement, and we see that very, very seldom in an African context. And then there was obviously the updated guidance on intangibles, and in particular the introduction of the the concept of hard-to-value intangibles. And then the latest development from an OECD perspective was the introduction of an updated guidance on intergroup finance. So that kind of sums up the latest developments from an OECD perspective. Parallel to that, there's always the development from a UN perspective, and in particular, the updates to their practical manual on transfer pricing for developing countries. That to a large degree provides a more practical approach. It gives more practical guidance than the OECD guidance, and it takes into account, in particular, the interest of emerging market economies. So, for example, what it deals with, what the OECD guidelines don't deal with, is the acknowledgement of the lack of comparables, in an African context, also the lack of experience and skills, and also the complexity of the general transfer pricing rules. And then last but not least, I think one also has to just look at the increase of profile of ATAF in the area of transfer pricing in the African continent. It's been very strong in supporting, the introduction of legislation and transfer pricing capacity. And it has also been very, very vocal in the context of the discussions on Pillar 1. And it has been actively, pushing for the shift in taxing rights to market economies and the simplification of transfer pricing rules. Unfortunately, the project on Pillar 1 has come to a bit of a standstill, and it looks like that might not go ahead because it hit a lot of resistance from the developed markets, in particular the US, and also a number of countries in the EU. So I think that's a kind of summary of the last few years from a global perspective.
And thanks, Jens. Very interesting. And it seems to be a lot of developments that's obviously important to be taken into consideration. Renee, if we can maybe ask you to chat a bit about the situation in Rwanda. I do understand that Rwanda has got its own transfer pricing guidelines that's based on the OECD guidelines, but with some differences. If you maybe can tell us a bit more about that.
Thank you very much, Celia. Indeed, one of the main developments Rwanda have seen in terms of transfer pricing is the new transfer pricing laws or legislation, which was enacted as a way of a ministerial order. So it's largely based indeed on the OECD guidelines. So it has, all the 5 transfer pricing methods, from the cap to the profit split method. It also has the whole section about comparability. Then it has specific provision dedicated to intragroup services and intangibles. But of course, it also has some peculiar features which are not maybe common to what we have in the OECD guidelines. So for instance, it applies to controlled transactions between resident entities. So it does not only apply it does not just apply to cross-border transactions. So there's also that element of it being applicable to transactions between unrelated parties, when one of the parties to the transaction is a resident in a country that has a beneficial tax system. So, and according to the rules, countries that may fall under that category are those which are taxing income at a rate that does not exceed 20%, where there is also that element of secrecy, and which do not require commercial substance or economic substance, for a company to benefit. To benefit from their tax regime. So another interesting feature of the new transfer pricing rules is that it does not apply to dealings between the permanent establishment and the head office. So, and this is likely, to pose a kind of risk in terms of, allocation of profit between the permanent establishment and the head office, and it may lead maybe to this unlimited force of attraction. So another development in Rwanda, which is still relevant to transfer pricing, is the accession of Rwanda to the OECD Mutual Convention on Mutual Administrative Assistance in Tax Matters. And this is also very relevant, especially when it comes to the exchange of information. So that's quite briefly what I can share in terms of the development we've seen in Rwanda over the last 2 years in the area of transfer pricing. Thank you.
Thanks, Renee. And I think maybe if I can ask the RRA representatives, what has your practical experience been with the implementation of these guidelines and legislation in Rwanda? Judy, Innocent, or Vincent, over to you.
Thank you, Celia. Well, from our experience in Rwanda, maybe for a start, it is good to lay a background on where Rwanda is coming from. Rwanda is not a signatory to the MLI, so it is not a member of the BEPS inclusive framework. It is not really bound by timelines to implement the BEPS minimum standard. And on the issue of signing the MLI and joining the BEPS inclusive framework, really, we are not in a position to comment on that in this framework or in this platform. It is a policy issue, and I would beg not to comment on that. But I would want to talk about the developments that we have been having as RRA in terms of international tax and transfer pricing. For a start, RRA is trying to review its legal framework, the laws that are in existence, and the legal instruments, so that we can accommodate and adopt to the best international practice. For example, the transfer pricing guidelines that Dieudonné has talked about just now. Soon we'll be having the general anti-avoidance rules, provisions, and probably regulations, and the advanced pricing agreements, APA regulations. RRA also has been conducting transfer pricing audits for a while, and we have audited quite a number of multinational entities. In terms of the treaty network, Rwanda has a wide treaty network with more than 15 countries, and Rwanda implements the exchange of information article from all those treaties, and it has an EOI unit, exchange of information unit, which is used to receive and send information for taxpayers where information is not availed. In addition to that, Rwanda in July 2021 signed the MAC, and it will be effective from January 2023. We expect the exchange of information unit to grow because of that, since we'll be having automatic exchange of information. I think that is all I can add in terms of new developments from our side, unless any of my colleagues wants to add anything. I think that is it from our side. Thank you, Celia.
Thanks, Judy. Yeah, that's very, very useful. And I know Rwanda has been very proactive to update legislation, in order to establish itself as an international or intermediate holding company and hub for the region with the Kigali International Financial Center and updates to the investment code. So, yeah, it's quite exciting, all the developments that have been taking place in Rwanda. I think if we get a bit more specific now on the specific changes that we've seen and developments in transfer pricing legislation, I think as Jens has alluded to, there's obviously a big focus being placed by the BEPS program of the OECD on eradicating tax avoidance and specifically low functioning entities with a main focus on intangibles. Jens, do you want to chat a bit more about the developments that you've seen in that respect?
Yes, thanks, Celia. As you rightly pointed out, that is one of the most the main focus areas, and those kind of low functioning capital rich entities in the past in the African context were mostly marketing or procurement hubs in the extractive industries, and I think that's kind of where it comes from. That's what you still see, in a lot of countries being abused. But the focus from an international perspective is more and more, moving away from that kind of old industries to IP heavy businesses such as platform based businesses, and the role of intangibles and the risk around that is particularly important. So let's, for example, look at a Pan-African multinational enterprise which conducts a platform based business through which it sells its products or services. So the platform would be owned in let's call it a tax friendly jurisdiction such as Mauritius, which would exploit that intangible through sales to related and unrelated parties across Africa. The development of that platform, however, would take place by a related party in Rwanda, for example. So the potential issue if you look at the new transfer pricing guidance on intangible, the potential issue in that scenario is that for transfer pricing purposes, it's possible for an entity like the Mauritian company to be the legal owner of an intangible, such as the platform, but nevertheless still not be entitled to the residual profit from its exploitation. And basically, that would mean that there could be a mismatch. The legal owner could then be not really the economic owner. So in the case of in a specific example, that would mean that the Mauritian company could most likely be audited from or kind of the transaction between the Mauritian company and the company in Rwanda could be audited by the Rwandan tax authorities, and the RRA could then claim that only a limited amount of the revenue generated through the group's use of the platform is in fact attributable to the Mauritian entity, and that the majority of such revenue should be treated as accruing to the Rwandan entity and accordingly be taxed in Rwanda. So that would be, the approach that the Rwandan tax authorities or any tax authorities where the development function takes place could take. So that obviously leaves us then with the question, how do we determine who the economic owner of an intangible is? We know that the legal ownership is the starting point, but then there's the analysis who is the actual economic owner. And there, the OECD guidelines say specifically, as I just mentioned, that the legal ownership is just a starting point, but that the question who the economic owner of an intangible should be determined based on analysis of the economically relevant circumstances to the transaction, including, again, the functions which the parties perform, the assets they use, and the risk they assume. So in a case of transactions involving intangibles, the requirement is to pay particular attention to the functions, assets, and risks relating to the development, enhancement, maintenance, protection, exploitation of the intangibles, which is we call the DEMPI functions. So that, however, doesn't mean that an entity must undertake every aspect of the DEMPI functions of an intangible itself in order to be entitled to the residual profit from its exploitation. And that makes logical sense because in the context of third-party arrangements, it is common for a legal owner of an intangible to outsource the various aspects of an intangible's development, enhancement, protection, or exploitation. However, the essential feature of a third-party outsourcing arrangement would always be that the outsourced activity take place under the control of the legal owner. It's therefore important that when you look at that in the intergroup context, that if a legal owner neither performs the DEMPI function itself, nor controls their performance, then that entity should not be entitled to any of the ongoing benefit attributable to the performance of those DEMPI functions. And in that context, it's also important to understand that there are certain activities which have a particular significance and which cannot be outsourced by the legal owner. And examples of that, for example, are, the direction and establishing of priorities in respect of a development program, the control over the strategic decision and direction of that development, and also in particular the management and control of those budgets. So for the Mauritian entity to be regarded as the legal and economic owner, needs to be control of that process. If it is not in control of the process and a lot of those control over risk activities are performed by the developer, for example, which would be sitting in Rwanda, then a portion of that residual profit should actually be allocated back to Rwanda, and a remuneration of the Rwandan service provider for example, on a cost-plus basis would then not be appropriate. I think that's kind of the crux of it.
Thanks, Jens. And now, what are the specific rules or guidance that's available in Rwanda in respect of intangibles?
Thank you very much, Celia. And as I mentioned earlier, so with the new transfer pricing rules, so it also embodies this DEMPI functional analysis. So basically, it is that shift of appreciating that, for returns from exploitation of intangible to be allocated, you have to consider who is, the economic owner, who are performing all these functions in terms of development, enhancement, maintenance, protection, the exploitation of the intangible. So maybe we need to wait and see how it would work is like the practicability of especially this DMP functional analysis and application. But the framework is quite similar with what we have under the OECD guidelines. So, and another aspect we have under the TP laws in Rwanda is about the allocation of returns from the hard to value intangibles, especially if I was to use the example of pharmaceuticals. Think of a case where an invention is transferred during its development phase, before its completion, and it's not clear whether it's going to become successful or it's going to be cleared by the regulatory authorities. So in that case, for instance, it may be undervalued, but at the end of the day, so you may realize that the return that is coming out of that intangible is way above or way below what was agreed. So in that specific case of HTVIs, so the new transfer pricing rules are also introducing this aspect of adjusting the ex-ante pricing based on the outcome of what happens after the transaction was entered into. So that's basically what I can say in terms of the application of transfer pricing to intangible transaction in Rwanda.
Thanks, Dieudonné. Judy, Innocent, and Vincent, I'm quite interested to hear your practical perspective on the application of the guidelines in respect of intangibles and the complexity surrounding that. What are your views on that?
Well, thank you, Celia, and really I appreciate what Jens and Dieudonné have talked about, because it lays the background on where we are coming from and the practical issues that we have come across. Maybe for a start, I may mention that it is really painful to watch a multinational entity operating in Rwanda that is exploiting a certain intangible, like really, and benefiting from it, and it does not pay royalties for that intangible, thereby denying Rwanda an opportunity to gain from withholding tax. These are some of the examples we come across. Others include overpayment of royalties. And also on this issue of overpayment of royalties, sometimes really you cannot tell what the intangible is that warrants a royalty. And taxpayers find it hard to even do a DMP functional analysis to justify why they should pay any royalty if actually it should be paid in the first place. Another issue that we have been observing, and Jens has really introduced it in a very nice way, is on the issue of payment of royalties to entities that are not the economic owners of the intangibles. And most of these, of course, are legal owners, and they are in low tax jurisdictions or in jurisdictions that have tax treaties with Rwanda. So technically, they're just treaty shopping. They are not residents in the countries that they are domiciled. So these are some of the technical and practical issues that we come across, and we are really trying, and we are hoping that taxpayers will comply in the long run with regards to the transfer pricing guidelines that were introduced in December 2020. Thank you.
Thanks, Judy. Yeah, it's quite a complex issue, and I think that, as you say, to do those analysis, you need a lot of experts on your side to help with that. Innocent, Vincent, would any one of you like to add anything to this?
Thank you. Just what I can add is that after conducting some audits of TP, where we find some of the issues, we do provide some recommendations, and it's good that some of the taxpayers have come forward to say, we are really appreciate what the adjustments has done, and then they come forward to make some rectifications under the years that have not been conducted for audit. So it's something that is very impressive now that taxpayers are really trying to comply with these recommendations that we do provide to them after finding out these issues. That's what I can say. So we are happy for that, for the amended legislations that are being.
Yeah, I think that collaboration between taxpayers and the tax authorities are quite important, to come to the correct answer in the end. Renee, I think one of the key focus areas of transfer pricing is very often intra-group services. And I would imagine that companies in Rwanda would often be making payments out of Rwanda to foreign head offices or holding companies or service companies in groups. What is this position on the transfer pricing rules surrounding intergroup services in Rwanda currently?
Thank you very much, Celia. So on this specific aspect of intragroup services, so there have been a shift when you look at the TP rules, particularly where the transfer pricing was generally approached from a perspective of the pricing of a service, whether the charges at arm's length or not. But now we are having a specific section under the TP rules dealing with intragroup services, and which is focusing on what we call benefit test. So it sets 3 criteria to be satisfied before a charge can be made for an intragroup services. And the first criteria being the fact that the service has been actually provided to the Rwandan, to a related party. The second one being that the provision of such services providing kind of economic or commercial value to the recipient of the services. And the third is that a third party in comparable circumstances will be willing to pay for the same service, or have someone providing or performing such service in-house. So and then the fourth one will be the normal application of relevant transfer pricing method, and reaching out at an arm's length outcome. So, but from that then arises a number of issues, and we've seen this for some of the audits have been conducted by the Revenue Authority and the cases in courts. So, for instance, on the first element, which is the fact that a service has been actually provided to the recipient. So this puts into question some of the service charges which are made, between related parties. For instance, we have what we call on-the-call services. So where the service center within the group is making available resources and the team to provide the services, and the charge is made for that, even if no request for such services is made throughout the year. So another challenging aspect is about what we refer to as duplication, where, for instance, you're having some people in-house, but you are also paying a service charge to the service center of the group for maybe the same functions which are as those that are performed by in-house team. So basically, what this is suggesting, it means that when dealing with transfer pricing aspect of intragroup services, so the focus should be shifting, and the taxpayers need to make sure that they are only paying charges, or they are charging services which have been actually received. And in this specific controversial aspect, I mean the on-the-call services and cases involving duplication, they need then to do a proper comparability and analysis and see whether, if, for instance, the fee they are paying for the on-call service, let's say an IT maintenance service, which is never used throughout the year. So it's something that will be possible even for independent parties in comparable circumstances. So I think that's what I can say when it comes to intragroup services. Something which is, I would say, has been there for years in risk guidance, but quite new in our jurisdiction. Thank you.
Thanks, Renee. Yeah, I think the theoretical rules seem to be quite clear, but I can imagine there's some complexities applying this in practice. So, Judy, Innocent, or Vincent, how would you typically apply the benefits test? I think the one thing that kind of came to my attention is this whole evidentiary issue. Like, how do you kind of actually confirm whether an intergroup service has actually been provided and the benefit was obtained by a Rwandan entity? How do you apply these kind of rules in practice?
Thank you, Celia. And really, it has been an issue for a while now, because the first test before we go anywhere with regards to an intra-group service is to establish whether a service was indeed rendered. And some of the evidences we ask for usually include correspondences. For example, if we have management fees or IT support services, we would expect a recipient entity in Rwanda to be corresponding with the service provider. So we would expect maybe an email or a letter. Timesheets also are things we expect, or even reports of work done. Usually taxpayers struggle with providing these to prove that the services were indeed rendered. They often feel comfortable providing just contracts and invoices, which really do not are not really convincing, because I mean anyone can do that in the back of their desk. They can just come up with a contract or an invoice, but really there's no service that was indeed rendered. Dieudonné also talked about other issues that we consider when we are looking at whether a service was really provided, and this includes duplication of services. You may find that an entity here in Rwanda has, for example, a legal department, and it is receiving legal services from abroad. When we ask about delineation, or for them to show us where the international service provider is doing or what they're doing, it's always a problem. There are other issues like shareholder activities and incidental benefits. These are some of the considerations that we always do consider. I think that is it from my side, unless any of my colleagues would want to add to this.
Thanks, Judy. Innocent, Vincent, any comments from you?
What I can just comment is that practically our taxpayers, they are just familiar with the routine evidences. So they are not familiar with what would justify that really the service was provided. As Judy mentioned, what they just provide is just a contract and invoice. So it's hard for them to go beyond that. So they say, this is enough for us to justify that the service has been provided. But actually, if we want to go beyond that to find out if really the service has been provided, or to find out if it wasn't a shareholder's service, it's proved to be so difficult to them. And you find that they are not much aware of the issue of being, the issue of arm's length. They are not familiar with it. They think that if they provide an invoice and then the contract between the related party, then those would be enough to justify that the service was actually performed. So we are still making a sensitization about all of this, but at least wherever we pass in terms of auditing, we do sensitize, and then we show them the importance of providing all of these, though at first they don't have all the evidences that we do request. Thank you.
Thanks, Innocent. Yeah, I think it's also to do with taxpayer education, and I think clarifying the guidelines on exactly what the requirements are. And I think you've given some good practical examples that will be very useful for taxpayers. Jens, maybe if I can ask you to speak a bit about the other side of the coin. Yes. Obviously, we've now spoken quite a bit about payments being made from Rwanda, but from a transfer pricing point of view, what are the issues that you experience, on the recipient of the payments, the head office or the service center in multinational groups?
So in my experience, especially the area of intergroup services in a bigger multinationals, that have big support centers with numerous employees, the risk of double taxation is quite high here, because on the one hand side, I understand that from an in-country perspective, from a Rwandan perspective, the benefits test is important, and obviously the local entity should only pay for actual services. If they would have also paid that to a third party, or would have had to perform that function themselves. But at the same time, you need to also understand the position of let's call it the head office, so the multinational enterprise, the head office or the service center. And obviously, while I understand that documentary evidence is important, a lot of people leave the profession that we are in, Celia, because they don't want to keep timesheets. And obviously, ultimately, if the burden of providing documentary evidence gets too high, then effectively you need to force hundreds of people in a multinational enterprise providing support service to keep timesheets, because otherwise you won't be able to show the actual benefit or the actual services provided. So I think there needs to be a balance between, on the one hand side, the very clear understanding of that there is a benefit, or the understanding that there needs to be documentary evidence on the one side, but on the other side it also needs to be practical. So that's the one side. Otherwise you have to employ more people just to administer that process, and then the charges become more and more expensive, because some of the big issues around intergroup services is that on the one hand side, there is a cost base, and obviously the transfer pricing rules require for that cost to be on charge with a markup if you apply the general principles. On the other side, obviously those charges might seem as excessive in country because of the cost base might be quite high. So for example, costs being incurred in the UK, the US, or South Africa at much higher salaries than they would be in Rwanda. So that mismatch is very often an issue. And then the other issue is also very often of the question around the characterization of those activities. What is a shareholder activity? That's the one side. What is the intergroup service? And we heard about the issues there. And then, very often a multinational enterprise ends up in a situation where a big chunk of their head office support they actually cannot recover, and then they have to ask themselves the question: what is it? Is that an intergroup service, or is it a shared activity, or is there maybe something in between, like an own activity that they perform for their own benefit rather than for the benefit of the subsidiary? And then the question is, how is that going to be treated? Is it tax deductible or not? So I think there's a lot of nuances in there which need to be considered.
Thanks, Jens. I think one of the other areas that seem to be the latest focus of the OECD is intergroup finance. What is the current situation as per the OECD on that, Jens?
Yeah, Celia, that is the latest updates to the OECD guidance go around the intergroup finance. And that is basically chapter 10 of the OECD guidelines has been completely revamped. And if one looks at it, one needs to understand that the purpose of that was really to align that guidance on financial transactions with the other changes that were made to the general guidance. So the starting point, again, similar to what we discussed in the context of IP or the general rules, is the starting point needs to be an accurate delineation of the actual transaction. And that accurate delineation needs to precede any pricing attempt. So I think that's important to keep that in mind. So there's basically three questions that have to be asked. The first one, is the loan really a loan? And that means you need to analyze the economically relevant characteristics, like is there a fixed repayment date? Is there an obligation to pay interest? And is there, is there the ability to obtain funding from a third-party bank? And in that context, it's also important to keep in mind that the label that you put to an instrument is not really important. It's the real nature of it. Then as a second step, once you determine that it is actually a loan, is then to identify the commercial and financial relations. And that means effectively what we would have called in the times prior to BEPS is an industry analysis. So we need to understand the economic cycles, in the specific industry, the industry regulations applying to that, and the availability of financial resources in that industry. And then we need to also understand how the multinational enterprise responds to those outside factors. And then as a third step, basically, we're looking at economically relevant characteristics of the actual transaction, of the actual financial transaction. And that there we apply the normal comparability criteria, like the contractual terms, the function analysis of both the lender and the borrower, the characterization of the actual financial instrument, the economic circumstances, and also the business strategies. So that's kind of the framework that is supplied by the OECD. And then the updated guidance also provides specific guidance on treasury functions, on financial guarantees, which are also always relevant, as well as the captive insurance industry. So, and then if you look at the arm's length nature of a loan, obviously you look at two things. You look at the quantum, and then you look at the interest rate. And in terms of the quantum, that's what kind of typically would have been called the thin capitalization rules. Basically, there's two options available for jurisdictions. It's either to apply the arm's length principle. That means, does the total amount of debt by a taxpayer exceed that which an independent third party would have or could have borrowed? The alternative to that is to codify certain ratios. So those ratios, whether it's debt to equity, whether it's interest cover, it doesn't really matter. That you can codify that alternatively. That means it's not necessarily an arm's length amount. It's more a policy decision. And I think my understanding is, Rwanda has partly also gone that way. And then obviously the other side is then the interest rate. And that basically, the latest updates to the OECD guidelines provide three options that you have, or three methods that you follow. The one is like the CUP method, where you obviously, comparable uncontrolled price method, a CUP method, where you either look at internal or external caps. And obviously the problem about that in the African context, it's very difficult to find comparables, to find real funding transactions that are kind of where the interest rate is publicly available in the African context. And then you have the cost of fund method, where you start with the borrowing cost of the lender, and then you add a risk premium plus a profit margin. And then you need to compare, obviously, that resulting interest rate with what the borrower would have been able to get in the market as well. And then the third option is an economic modeling, where you start with a risk-free interest rate, and then you add various premiums. So this is kind of the framework that the OECD provides for intergroup finance transactions.
Thanks, Jens. And Nay, what is the position in Rwanda? And do you understand that there are some codified ratios, such as a thin cap ratio? But if you can maybe chat a bit more about that.
Thank you very much, Celia. So maybe before I comment on one aspect, I need to add something to what Jens said in terms of the OECD guidance on financial transactions. So this element, of implicit support when you are assessing the credit risk or the creditworthiness of the borrower. So where this time around the OECD is advocating that the entity should not be looked at on a standalone basis, but there is a need also to consider the fact that it's a member of the group, and that may even enhance its creditworthiness. So I think that's something that is also becoming a bit disputed, but which is very critical when it comes to the determination of the arm's length interest in the financial transaction. So now coming back here in Rwanda, so Rwanda has not yet formally endorsed or adopted or codified the OECD guidance on financial transactions, but the practice, it's clear that they are being inspired by them in the way they are dealing with intragroup financing transactions. So, for instance, in some of the auditing reports, I've been able to read. So, the RRA is shifting, from looking at the consistency with the arm's length principle by the interest charged, but also looking at the nature of the actual transaction, its economic substance. And it is actually from this we've seen some of the shareholder loans being recharacterized as equity. So, and part of the factors the RRA have been relying on in recharacterizing the shareholder loans include some of those aspects listed in the OECD guidance on financial transactions, including absence of the repayment period, the payment capacity of the borrower, absence of security, covenants, aspects like the fact that the loan does not have a specific repayment period, the loan is interest free. So and one would say that indeed, even if it's not formally adopted, but it has a significant place in our system. And very interesting, I've even had cases involving the applicability of this OECD guidance. So the one I'm referring to in this specific case is pending before the court, but at least the lower court has decided on this, where it's decided that the OECD guidance on financial transactions should not be applying retrospectively for transaction entered into between 2020. But as you can imagine, so for future transaction, maybe the court may take a different position, especially with the provision we have under the new transfer pricing rules, which does allow the revenue authority to disregard a transaction, a related party transaction, where it is not commercially relational. So that's what I can say in relation to the OECD guidance. Then when it comes to the thin capitalization rules, so we have thin cap provision under income tax law, which is 4/1. But I understand that this law is being amended, so the ratio itself won't change. But one of the proposed changes, the last time I saw the draft, is that this went also to be extended to foreign exchange losses resulting from a loan between related parties, while what you have now is only limited to interest. Thank you.
Thanks, Tirunai. Vincent, what is your practical perspective from an RRA point of view on financial transactions in Rwanda?
Oh, yeah, thank you so much. Yes, as auditors in international taxation area, we also meet such challenges where we see taxpayers acquiring loans from related parties. And when you analyze the issue, you find that actually the companies, the taxpayers here are highly leveraged. Because even when you request from maybe, for example, from their business plan, which they submit when they are registering their businesses, you find that they are proposed to finance the company or the enterprise by getting money from the shareholders as equity. But when you go to the actual practice or the actual conduct, you find that the company is only getting the loans from related parties. And when you analyze the contracts of the loan, you find that these loans are actually don't have the repayment period, they don't bear interest, they don't have covenants. So, so when we see such things, and we have to also to come back to say, is this really a loan, or is an equity that the company should recognize as equity? Because at the end, these loans, because they are acquired in hard currencies, they attract foreign exchange losses. Though they are interest-free, but they attract foreign exchange losses, which are in huge quantities because our currencies are actually fluctuating compared to hard currencies. So, and these foreign exchange losses, they erode taxable base in Rwanda. So when we see this, we come back to say, is this really a loan respecting the arm's length principle? Because everything has to respect the arm's length principle. So we say if the loan is not having the repayment period, if the loan is not having the covenants, if the loan is, the company is not having capacity maybe to pay back the loan is just the loan is just accumulating within the financials of the company. Is really this loan respecting the arm's length principle? So we start from there and say, if we compare this one maybe to a third-party loan, we see that no independent party would be able to give a loan to a company which is not able maybe to pay back. No independent company would be able to give a loan without knowing when this one will be paid back. So based on such scenarios or circumstances, we say that this one shouldn't be a loan, actually it should be an equity, and we end up recharacterizing the loan as equity, and we tend to reject the foreign exchange losses, because these foreign exchange losses, they erode taxable base. Thank you.
Thanks, Vincent. Yeah, I should say it's obviously all about the substance of the actual transaction. I think obviously the base for the RRA doing audits and kind of making assessments on transfer pricing is transfer pricing documentation. And I see someone has just posted the question as well, asking what are the documentation rules in Rwanda. So if I can ask someone from the RRA maybe to briefly just highlight the types of documents and maybe specific turnover or other thresholds that need to be complied with before documentation is required.
Yes, thank you, Celia, for that. Maybe for a start, I would want to highlight the name of the document. It is the Transfer Pricing Guidelines 2020. The documentation requirements are from Article 17 through to 20. I will just summarize from the top of my head. Some of the documentations that are required, not just from the top of my head, I'm certain, include the transfer pricing document, the documentation, and the benchmarking analysis to support the arm's length nature of the intra-group transactions. We also expect the taxpayer to have copies of all material intercompany agreements and the country-by-country report. There's also a transfer pricing annex. I will address that in terms of its complexity or simplicity in the just shortly. Then there's every taxpayer, M&E, is expected to have the latest group structure, shareholding structure, and management structure, and any other documentation that they may deem necessary to determine compliance with the arm's length principle. Now, in terms of the timing for preparation of these documents, the country-by-country report or CBC report must be filed with RRA, within 12 months after the last day of the financial year of the M&E. So for example, if the last day of the financial year is 31st December, let's say 2021, it must be filed before 31st December 2022. For the group structure, it depends really on whether the company is new or not. For new companies, they were supposed to have submitted the group structure by 31st March 2021. For new companies, they are expected to submit their group structure together with their first CIT, corporate income tax declaration. For the transfer pricing policy, benchmarking studies, material intercompany agreements, they must be in place in the taxpayer's premises. The taxpayer is not expected to submit them to RRA unless requested. And when requested by RRA, they should provide them within 7 days from the date of request. Now, you also mentioned about taxpayers that are discharged from the obligation of preparing documentation. Well, there's a turnover threshold of 600 million Rwandan francs. Any taxpayer with a turnover below 600 million is exempted, but this is not the only condition. There are other conditions in addition to the threshold of turnover. For example, they must not have a transaction, a control transaction that is above 10 million Rwanda francs. And in addition of that, the aggregate of all intra-group transactions must be below 100 million Rwanda francs. So for example, you may find a taxpayer with a turnover of 500 million Rwandan francs, and they have 3 transactions, but one of the 3 control transactions may be of 5 million and 11 million. Just because of that transaction of 11 million Rwanda francs, they have to prepare the transfer pricing documentation. Then that is not all. Even if a taxpayer meets the threshold, all their transactions must comply with the arm's length principle. That is if they are discharged from preparing the documentation. Then there was a question we saw somewhere about whether we can have a simplified transfer pricing annex. In our view, it is highly simplified, and it cannot get simpler than the template. I think that is it from our side. Thank you.
Thanks, Judy. Now, you clearly know the rules very well to be able to speak so fluently to it. Thank you. Renee, we've received quite a few interesting questions. I'd like us to have a bit of time to address 1 or 2 of those. But maybe just briefly from your side, what are the practical issues that taxpayers have been experiencing with the documentation requirements? I know it's relatively new rules, but have you seen any specific issues that taxpayers and clients have identified?
Well, there may not be issues as such, because now that the regulations are quite thorough, so there is no requirement to make the filing of the transfer pricing policy, apart from preparing it and have it available. So, and one of maybe of the nice thing I would say is this template, which is an annexure to the transfer pricing rules, which indicates the kind of related party transaction information that need to be filed to the revenue authority, along with the income tax return at the end of each tax year. So it may not be really that challenging, but of course, as you can imagine, this is something new. We only had this since 2020. So maybe from a practical perspective, some challenges would be encountered all around. But so far, I would say that based on the regulations and interaction you have with clients, so this should not be a problem. But maybe when it comes to the content of the transfer pricing itself, especially on the comparability analysis, so that's why there may be an issue, because I think that was even highlighted by yes, and it's common for most of the African, jurisdictions, the lack of comparables. So the lack of comparables is a serious challenge. But again, there is also a leeway on that in terms of the TP rules, because the TP rules provides that in the absence of local comparables, then the parties would be allowed to look for comparables, outside Rwanda, which may be, of course, in terms of cost trick, but at least there is that flexibility. Thank you.
Thanks, Dirunay. Yates, I'm not going to ask you about the global position, just in order to give us a chance maybe to kind of address one or two questions. I think one question that has come up more than once, and I think this is a question for the RRA, is the interaction between the limit on intergroup service fees, management and technical assistance fees, that's currently limited to 2%. How does that interact with a transfer pricing policy if you already have a restriction of this 2%? Judy, Vincent, Innocent, any one of you, do you mind commenting on that, please?
Yeah, thank you. Maybe my colleagues will just add on. But what I can say on that is that though 2% cap is there, okay, the excess is already rejected or added back by the taxpayer himself. That's good, but the 2% also has to be at arm's length. That has to be justified and find out whether this payment is really at arm's length. Then, if you find it is arm's length, then it's in the limit. Then it's allowed. But if we find that it's not in the arm's length, then it has also to be adjusted. That's the issue with this capping of 2%. Thank you.
Perfect. Thank you so much. And Jens, maybe a question for you. Somebody asked a question. If different parties are contributing to DEMPI functions, would a profit split be appropriate, or how would you kind of make an allocation in a case like that?
That would certainly be one option. I mean, the question, you would have, so basically you would have a legal owner that most likely would be the contracting party that exploits the intangible, either through licensing it out or actually providing services. And then you have a number of entities which contribute to the DEMPI functions. Obviously, in an ideal scenario, there should be one entity that controls that development process, and that entity would then be the one that has access to the residual, and then the other entity should be remunerated for their routine functions. But if that is very, very gray and it's difficult to find that one entity, which is unlikely, then I guess you could also apply a profit split method.
Thank you. And maybe, I think we literally have 1 minute left. So just one last question to the RRA. Somebody asked a question, the country by country report, does Rwanda has its own format for that, or would the format that's kind of used in the head office jurisdiction be acceptable?
Well, in Ghana, we don't have a specific format for country by country report. As you know, the country by country report is always prepared by the recruitment parent company. So you may find that the parent company is not residing in Rwanda, it's outside Rwanda. So we depend on what is prepared by the related party or the recruitment parent company. So what they provide to the subsidiary company, maybe that is in Rwanda, is the one that should be submitted to the tax administration. Thank you.
Thank you so much. Unfortunately, we've run out of time, but we will try and, as far as possible, address some of the other questions that have come in by email afterwards. But I think all that remains for me is to thank all our participants, and a particular word of thanks to Innocent, Vincent, and Judy. Thank you so much for making the time available and for the very useful information that you've shared. I'm sure all of our attendees really appreciate that and find it very useful. Jens and Dinone, thank you both. Yeah, and if you need any assistance on transfer pricing or any other tax matters, you know where to find us. Thank you so much and goodbye.
Thank you so much too.
Thank you. Bye.
Thank you. Bye.